one reason I've been focusing on this a lot lately is if I go back many years to 2016, 2017, um, one of the things that made me more interested in focusing on macro versus equities, I cover a lot of equities, but my historical and focus on investing was, value investing or growth at a reasonable price investing, kind of analyzing equities. And the reason I began emphasizing macro more is because we started to get an unusual phenomenon. So normally budget deficits in the United States are highly correlated with the unemployment rate. So low unemployment, smaller deficits, higher unemployment, higher deficits.
Financial analyst Lyn Alden delves into a critical shift in the economic landscape. With an astute historical perspective, she explores the intriguing connection between fiscal policies, deficits, and inflation. Alden uncovers a unique divergence in the economy, where unemployment rates and deficits once moved in tandem, but now reveal a new paradigm. This intriguing phenomenon, coined as fiscal dominance, emerges as a focal point of her analysis. Join Alden as she dissects the intricate interplay between macroeconomic forces and monetary policies. Just when you think you've grasped the dynamics, stay tuned for the jaw-dropping revelation about how decades of fiscal trends are shaping a future that's both fascinating and, perhaps, precarious. Don't miss the electrifying conclusion that unveils the hidden forces driving today's economic landscape.
And in that 2016-27 timeframe, we started to see a decoupling. So the unemployment rate was going down, but deficits, which had been going down as a percentage of GDP, began widening. And when you looked into why, it was largely a demographics issue. So as the top-heavy entitlement programs, which were in place, as the very large baby boomer generation began entering retirement in size, we started to get this divergence where you have large deficits even when you have low unemployment. And of course, they blow out during an entity like an aspect like COVID, like a period like that. And so the early signs of fiscal dominance began back then. Of course, back then it was a very small thing, but it's showing the initial trend change. And basically, in my view, that said, okay, some of these things that people have talked about for decades that they were often too early on are actually starting to materialize. And it'll still take time, but they start happening to be discussed and analyzed. Mm-hmm. And I think what we're seeing this year is a more tangible example of fiscal dominance. So for people who haven't followed the topic, fiscal dominance is basically when a government runs such large deficits and has such high public debts that they can in some ways override monetary policy, that they become a bigger force. And so if you have an environment of low deficits and low public debt to GDP, then generally speaking, monetary policy is going to have a bigger role to play than differences in fiscal policy. Whereas if you have an environment of high deficits and high debts, especially if there's no clear path, like a political path to fix those, and that therefore they're expected to be around for a long time, even if it's a problem, then that fiscal policy can override monetary policy. And so basically the way that monetary systems tend to get reset or rebuilt is basically you have a system, it's incentivized to run large and large deficits over time. And eventually and all those deficits accumulate into very high debt as a percentage of GDP ratios. And so for the past 40 years, and this is why the problem's kind of happening now. So for the past 40 years, we've had steadily rising debt to GDP, 30%, in the beginning of 1980. So 30% debt to GDP up to, call it 130% of debt to GDP. But that was offset by structurally declining interest rates for 40 years. And so the interest expense was never really a problem, and it was kind of held in check. The problem is that after 40 years, as you run into zero, and now we bounced off zero, and if we're going flat to up now in terms of interest rates, those ongoing deficits and debt as a percentage of GDP are going to mean that interest expense begins growing a lot quicker than we're used to. Money that's pouring into the economy, that's increased deficits. So you get deficits beget more and more deficits. And generally speaking, that's how these systems end. And of course, every end is a beginning. So that's how these systems tend to get, recapitalized, reset, however you want to call it. Generally, these big monetary, macro, geopolitical things happen around these environments. So that's why I think fiscal dominance is such an important thing to be covering right now. And then in the intermediate term, what it's doing is it's pushing back a possible recession, or it already has pushed back a possible recession, because it's essentially a type of stimulus. So, for example, if we look at how much deficits were being run during the Great Recession of 2008, 2009, and you look at how much deficits they're running right now before a recession, it's actually like you're almost like pre-stimulating before the recession. And so that's kind of the environment we find ourselves in. If you define it as price inflation, right? So on one hand, you have supply of money changing. That's a key variable. And then the other side is various types of productivity or supply side limitations that make those increased money supply actually result in higher prices. So for example, no matter, like a television has gotten cheaper over the past 20 years for a similar size and quality, despite the fact that money printing keeps happening because the technology has been so deflationary, right? So those are the two main variables to consider. And then when we answer the question another way, what are the two main sources of money creation then? So one of the main sources is bank lending. So when banks in a fractional reserve system, when they lend money, they create new deposits. They lever up the broad money supply relative to the base money supply, and they create more broad money. And that's spendable money that we have, and that can, so periods of elevated credit creation, bank lending, can result in more money out in the system, more deposits chasing similar amounts of goods and services. And so you can get a lot of price growth. During the 1970s was kind of the key period of that. If you go back from the present day all the way to the second half of the 1800s, the period of fastest bank lending growth was the 1970s. And that was in large part because the baby boomer generation, which was, the early ones were born in the late 1940s, they began entering their 20s and began entering their family creation, home buying years. And one of the biggest sources of credit creation is mortgages. And so you had a lot of building, construction, credit creation. And of course, you also ran into supply constraints. U.S. oil production peaked in 1970. We became more reliant on imports. And so that was a supply constraint that our elevated money supply creation ran into. So that's basically how you'd summarize the 70s inflation. The other type of money creation is large monetized fiscal deficits. So even if banks aren't lending much, if the government just issues a ton of bonds and then gives everyone $1,000 or $5,000 and then tells its central bank to create more base money and buy those bonds, whether it's on the secondary market or not, that increases the amount of broad money supply and circulation again. And so in the 1940s, for example, which was just as inflationary as the 1970s, it was not because of a demographics bulge. In fact, demographics were pretty weak. It was not because of bank lending. Banks were barely lending at all. It was because the United States was running absolutely enormous fiscal deficits to fight the war. And that money meant soldier salaries, buying commodities, buying manufacturing facilities. When the soldiers came home, they put them through college and technical school and gave them mortgage assistance. And this was just a massive amount of new money creation, which was very inflationary. And so basically, when you contrast the 70s and the 40s, you get two very different understandings of how money creation can happen, and they're both true. And so you have to, basically, when we're analyzing inflation, we look at what is the source of new money supply, and then what sort of real world constraints is that new money supply running into.
As we reach the end of this captivating exploration into current economic events, I hope you've gained valuable insights into the ever-evolving financial landscape. Remember, staying informed about the latest economic developments is crucial in today's interconnected world. By understanding the forces shaping our economy, you can navigate the uncertainties and seize opportunities that arise. Whether it's market fluctuations, policy changes, or global trends, staying engaged with economic news allows you to make informed decisions that impact your financial well-being. Stay curious, stay informed, and don't forget to like, comment, and share this video.